policies. What do you see as the consequences of further easing measures on the economy? Is it further erosion in credibility? And then the second question is, in your mind, given how much the Fed has eased this year, would you have expected that the Fed need to tighten with greater force in 2012 than you would have previously thought?
Okay, so those are good questions, and thanks for asking them. As you started your question off by observing, as I had stated after my dissent in August, it seemed to me that adding accommodation, as we did in August and again in September, was inconsistent with the changes in the economic conditions over the course of 2011. In particular, unemployment and the outlook for unemployment had fallen, inflation and the outlook for inflation had risen. I think that the goal of this particular speech is to try to lay out a framework for thinking about going forward. So I don't want to necessarily dwell on what's happened in 2011. I want to think about how we should be making policy in 2012. And I think we should be clear about to the public, as I indicated in the speech, about what we would be doing in a variety of contingencies. What contingencies would lead us to reduce accommodation? What contingencies would lead us to add accommodation? And I point to both in the context of the speech. I think we should be clear about what our objectives are and how what we're doing, how our contingency plan helps us get towards those objectives. I think one of the concerns I've had over the course of 2011, to look back briefly, is that our policy choices and the fact that they're not don't seem consistent with the evolution of economic data lead. One interpretation that can be made from that is that the committee is shifting the weight it's putting on its employment mandate relative to what it was putting on its inflation mandate. I don't have a problem with the weighting that we were imposing in late 2011 relative to the weighting we were imposing in late 2010, but that shouldn't be changing over time. And I think we should be much clearer and sharper about how exactly we're weighting these pieces of weighting these two objectives or statutory mandates that are imposed on us by Congress, and then articulating how our policy choices are helping us fulfill those objectives. I'm not sure if that was responsive or not.
So, but the Fed doesn't seem like it's heading in that direction. It actually seems like it's heading. People are talking really about additional asset purchases, more easing steps, and it doesn't seem like they're doing what you would have expected the Fed to be doing at this point.
Again, going forward, I think what's important for us is to be articulate about what our objective is, and then articulating about exactly how our actions would be consistent with that. I think Vivian, what you're asking is right, that if we were to stick with the same objective that we had, the way we were weighting our two mandates at the end of 2010, adding accommodation is not consistent with that. I mean, that's right. I think the question right now is we should be clear about what our objective is, stick to that going forward. Let's forget about what happened in 2011. Let's think about what's going to happen going forward. Have our objective in mind for how we're going to weight inflation and unemployment and deviations from how we're doing on those two mandates, and then be clear about how our contingency plan is helping us fulfill that weighting, that objective.
Is it going to be possible to reach a consensus on these objectives, because people have different notions of what the natural rate of unemployment is and what an acceptable rate of inflation is and what the various output gaps are and so forth and so on. So how do you arrive at these objectives that you want to?
I think it's a great question, Steve. I think it's I think that's the challenge we have to confront as a committee is talking about these issues, and I think framing the discussion that way and talking about that is better than framing it in terms of are we adding more, should we add more or less? That's not the right question. The right question is exactly the questions you're asking about what is the natural rate of unemployment, Where are we relative to that? I think those are the right kinds of questions. I think the committee has shown a willingness to go forward without consensus. So I don't think that's the insuperable obstacle. I think it's more we have to start framing the conversation in the right way.
But I mean, it does seem that there are those who, like you, seem to see that, we probably should be tightening or should be, in that direction, and other people who feel that we should be easing. I mean, what's the danger that whatever conversations we have about objectives are really, sort of a way of making sure, sort of justification of biases of easing or tightening? Is that not the way the conversation actually goes?
Yeah, I don't think about it that way. I think about it as having an objective in mind and then taking actions to fulfill that. And when I read my colleagues' remarks on this, it seems like they're operating with roughly the same kind of framework. So as I speaking for myself, what disturbed me about and why I took the votes I did in August and September at the FOMC meetings was not so much the particular weighting that was on those mandates, but rather the change in the weighting from what I perceived to be a change in the weighting from late 2010 to the latter part of 2011.
You said in your speech, we've all seen that if unemployment falls, inflation, if inflation falls and inflation remains the same relative to the November projections, that you thought that the Fed should tighten policy, but that if unemployment were to rise, inflation were to fall, that it should ease further. How has the European crisis changed the odds of those two scenarios?
Well, the first scenario that you described is the coming out of the baseline projections from the FOMC, the summary of economic projections the FOMC made in its meeting earlier in November. Those baseline projections had unemployment falling slowly, but falling over the course of 2012, and inflation remaining roughly the same. And I think that according to that baseline framework, then you would be reducing accommodation, albeit slowly, over the course of 2012. I can't speak for the entire committee about how those forecasts would have changed over the course of the past month. I think that, in terms of my own outlook, I would say that I still see unemployment falling over the course of, and the outlook for unemployment falling over the course of 2012, but perhaps even more gradually than I did at the beginning of November.
Why?
I think Steve alluded to the European situation. I think that the pace of events in Europe has led me to believe that that adverse outcomes coming from that risk are more likely than I did at the beginning of November.
So that presumably makes it less likely that the FOMC is going to need to or want to tighten, right? On my baseline forecast, you would still be looking at reducing accommodation on my baseline forecast.
I was going to say, there's lots of discussion today about just changing the language in terms of guidance going forward. How does that fit into your dashboard idea, or does it? Where do you stand on setting contingency based on unemployment inflation for guidance?
Yeah, I think some of the suggestions that I've heard in terms of guidance are less complete than what I have in mind. What I'm trying to describe is designed to include, shall we say, what we would do if inflation were to rise above 3% and unemployment was to fall below 7%, but give a sharper description of what we're going to do in these different scenarios than perhaps others have offered. So I don't really necessarily see a conflict. I'm trying to actually, I think, be more specific about what we do in a wider range of scenarios.
Does your idea of a contingency plan also, how how does that relate to the idea of providing a policy rate forecast the way that Forrest Benson is advocating?
I think that it's very consistent. I don't, to be honest, I think it's a mistake for me to try to put words in Lars's mouth. So, but I think by telling people what we're going to do. So, for example, my baseline scenario is the one we're projecting is going to take place. I think we should offer what we're going to do in terms of policy in that baseline scenario. I've talked about what would happen in 2012. Could easily roll forward to 2013 as well and talk about that frame as well. I think it's important for us not just to communicate, though, about what in the scenario that we expect. It's not just enough to offer a projection of what we think policy is going to be if things turn out the way we expect them to. It's also important to tell people what we're going to be doing if things turn out to be different from what we expect them to be, especially given the challenges we faced in forecasting over the last couple of years.
Do you mind responding to the question about whether you see a need for accommodation to be removed with greater force in 2012, considering how much we've eased this year? And what other measures, in terms of removing accommodation, would you support beyond changing or shrinking the 2013 pledge, the time frame for that?
Yeah, in terms of what are the appropriate level of accommodation is at this very moment in time, I would say that I'm open to hearing what my colleagues have to say about that. It's more important for me, I think, to have that put into context of what we're going to be doing going forward. If I knew how that fit into the plan going forward, it would help me understand what the right level should be today. And so that the reason I'm not answering your question is because I need to know about. I can't answer that in isolation. And the whole point of my speech is I can't answer that question in isolation. It has to be part of a plan going forward. I'm sorry, I've forgotten you had asked. What other kinds of ways of reducing accommodation I'd have in mind? I think right now the way I'm contemplating it is basically the Fed has sketched what the sequence of exit would look like in the June minutes. I think for us, reducing accommodation would largely be about reducing what length of time there is before that exit strategy gets implemented. So how long is it going to be before we raise rates, for example, would be one element of that.
So you said reducing, what you have in mind is really reducing the amount of time it would take before you actually get started.
Yes, exactly.
And you're not actually talking about getting started.
No, so I think I say this in the speech, that if along our baseline projection in 2012, we should reduce accommodation. What that should take the form of is basically being a shorter length of horizon before we start to raise rates. And really, what I have in mind is before we initiate exit.
Could you talk a little bit? There seems to be some real debate among the different among the FOMC members, and not just the Fed presidents, about how much technical term wiggle room the Fed has to operate, what the economy has to operate. Can you talk a little bit about, I guess, the differing opinions and how that all works is going to be working together?
I'm going to have to ask you to define your technical term. I'm not sure what you mean by wiggle room.
Okay, as I said, Yellen this morning saying, well, I think that there's scope of action. There's some scope we have there, and you have the Atlanta president saying, I don't think so. So you have diversity among opinions.
Yeah, I can only speak for myself. I was in the room when President Yellen was Vice Chair Yellen was speaking, and I found myself in agreement with her. I think we do have tools to use, and purchasing more assets is one, and offering forward guidance, different kinds of forward guidance is another. So I find myself largely in agreement with her.
How effective do you think that, obviously, clearer communication is a good thing in and of itself, right? But as an easing tool, how effective do you think it can be? Some people talk about it purely in terms of this is a way to ease policy. Others talk about it in terms of let's be clearer in how we talk about, our reaction function and so forth, so.
I think when it's always true, I think, that and we get hung up at it because we're at the zero lower bound, we can't lower interest rates any further than right now, that's when the future matters. But it's always true, it's a future sequence of moves that matters, because the short-term interest rate is not the thing that moves investment or consumption decisions. It's the anticipated sequence of rates that matters. That's always true, and the clearer we can be about that in a variety of scenarios, I think the more effective policy will be. Now, cutting a short-term interest rate by 50 basis points, which is it would be a big move in the normal circumstances. Why does it have so much content? It's because it's telling people what's going to be happening in the future, shaping their expectations for over the longer horizon. Now, what we have to do is use words to do that, because we don't have any market move we can make. But I think it's still the same kind of tool at the end of the day.
Can you talk about maybe the unintended consequences of Fed policies? Do you have any concern that the Fed's policies have created new trading and profit opportunities unintentionally without actually helping benefit the real economy? In particular, I'm talking about strategists and traders who tell us that there's an enormous energy that they're putting into these new trading opportunities.
Yeah, I guess. I think that it's. What's the right answer to this question? I think that there's and people. I don't really spend a lot of time thinking about how financial market participants try to arbitrage what they perceive to be profit-making opportunities. What we're trying to do through accommodative policy is to keep rates low. Both our asset purchases and by offering forward guidance, you're trying to keep rates low. Now, why are you trying to keep rates low? By keeping rates low for market instruments, it makes people, on the household side, it makes people think, gee, saving money doesn't look like such a great thing right now. Rates are very low. I should go buy something. And if they go buy something, that means somebody has to make that thing. And that means that there's going to be somebody hired. That's how we're helping on the employment side. The same side, by they're pushing up on demand, that means firms are less likely to lower prices, and that's helps us fulfill our price stability mandate. On the flip side, on the firm side, when rates are low in terms of market instruments, it makes them more likely to say, I should build that factory as opposed to. So, with all that said, there's always distributional consequences from any kind of policy choice. The Fed has two mandates: promote price stability, promote maximum employment, and we make our choices so as to fulfill those objectives as best we can.
Let me kind of ask the question a different way. Do you think it would be appropriate to have some skepticism about the effect that future purchases and clarification on or guidance on the rate pledge would have on the real economy at this point in terms of producing much gain?
I think that to go back to what the vice chair said this morning in answering questions, she referred to monetary policy not being a panacea. I agree with her. I would go further. It's the impact of monetary policy moves is likely to be what's the right word? It's going to move us in a further accommodation will have the effect we desire, but given the state of the economy, and given how much accommodation is already in place, I think the impact is likely to be marginal. Further marginal moves are likely to have marginal impacts.
In the speech you talked about the dangers of not being clear and credibility issues with the Fed. Are you worried that that's already starting to emerge at all? And if not yet, when? What are we looking for in terms of a breakdown in credibility?
So that's a good question. I think right now it would be hard to point to any particular metric that you could say that the Fed has lost credibility. I think what you'd be looking for in particular is upward drift in inflationary expectations. You do see, I think, an unusual heterogeneity among forecasts about inflation, and that's a little bit of a sign of a lack of credibility, at least uncertainty about where inflation is going to be. But I would say, by and large, my concern is one about the future, and less about what's happening in current measures of lack of credibility.
I just want to ask you about Europe, again, is what do you see as the potential there? I mean, are you looking at it as either it blows up and, send it into a crisis, or do you see it as, is it one or the other, or is it something? In other words, will it either resolve itself and there won't be an impact, or it will blow up and there will be an impact, or is there a gradation?
I mean, I think that the outcome in Europe is going to be the good outcome in Europe is going to take some time. And it's because the political challenges are very severe. So I think the good outcome is one that takes time to resolve itself. I think that means there's gradations. There's going to be uncertainties along that path about how, as we move along that good path, I think that we're going to continue to be uncertain about whether we're going to continue to be on that good path. And that's going to, how those uncertainties play out will end up influencing our economy. And I think you see that already in financial markets. I mean, the level, the volatility measures in the S&P have been elevated since the end of June. Some of that has come from conversations in our own country about uncertainties in our own country, about the fiscal situation, among other things. But a lot of it's coming from Europe. I think the uncertainties about whether we're going to stay on a good path, and I think we are on the good path. Staying on the good path, uncertainties about that will translate into uncertainties in our own financial markets.
You're obviously focused on the dual mandate, very clear and important, but the Fed's role in the global economy is profound. Would you calibrate any of what you're designing here for the events of a financial crisis? I mean, if Europe goes, is it just focus on what transmission there is to the economic outcomes, or does some of this stuff have to get adjusted for how to fix a European breakup, for example?
I mean, I think that adverse outcomes in Europe influence our thinking about how we're achieving the dual mandate. So I think the way I think about it is we've been given these mandates by Congress, and the way we should be thinking about how to about events in Europe is how it's going to affect the path of inflation, path of unemployment in this country, and we should be responding accordingly.
If your forecast were to show something, for whatever reason, as if those mandates were both not being met, you got a contradiction, but you also have this financial crisis. So you've got inflation rising, for example, you've lost confidence in the dollar, but you've also got this stagflation environment, unemployment rising, all built around the global financial crisis. Do you have to change the dashboard in some way?
I think so. One thing would be to say is that if you're in a financial crisis situation, there's a range of liquidity tools the Fed has available that many of which are really the province of the Board of Governors and not the Federal Open Markets Committee to get into niceties of Fed governance. In terms of making a monetary policy, which is what this speech is about, monetary policy doesn't operate any faster just because you're in a crisis situation. You should still be looking at that 1 to 2 year kind of horizon, thinking about that, thinking about how you're going to be achieving, how best to achieve your mandates given that. You've posed a counterfactual where inflation rises rapidly, maybe my inflation expectations are rising rapidly, and my unemployment expectations are rising rapidly. That happens to be a situation where it would be very important for us to offer clarification now about how we would act, but also be very challenging because then the tensions between the mandates really become pretty sharp.
Is it possible that the signals are being blurred by the European crisis in the sense that you do have this safe haven effect on capital inflows, which are keeping our long-term rates and hence signals about inflation expectations lower than they might otherwise be? Is that something that you need to take into account?
Yeah, that's not a concern that I have.
Could you talk a little about, we talked about forecasting. What are some of the, if you could talk a little more about the variables you see? I guess, talk about the unforeseen you could see?
Well, that's of course very hard because of if it's unforeseen, then it's pretty hard to talk about now. But to treat the question more seriously, I mean, I think that I think one of the great things about contingency planning is it really forces you to come to grips with that, and it makes you come to grips with the idea of, suppose home prices were to fall further. What would be the impact of the economy in terms of our dual mandate? What should we do in those circumstances? If we had somehow had both people became worried about holding a dollar, then people became worried about future inflation at the same time as we had upward pressures on inflation unemployment for some reason, as the previous question sketched. What would we do in those circumstances? I think that contingency planning, especially public contingency planning, really forces you to come to grips with these kinds of events and how you would, instead of trying to react on the fly to them, you're forced to react ahead of time and think it through. And so I think that the question you asked is exactly the question I'm trying to get at through the contingency plan that I'm offering here.
You've talked about this plan for a little while, and we've also got more other voices within the FOMC who have expressed concerns about the accommodative posture. But as you know, the conversation about whatever guidance language is there seems to be focused one-sidedly on the unemployment rate. Why is there a resistance, do you think, to putting out two sides of the story and just discussing the inflation risk aspect to this amongst your colleagues?
Yeah, I'm not even quite sure what you're referring to, so.
Well, there is been quite consistent. The Fed's positions have been highly accommodative, and there is it's asymmetrical in the sense that it's focused on trying to send a message to the markets that our biggest concern is unemployment, and we're going to do whatever we can to get there. And you're saying we need to also, there's other contingency of inflation. Clearly, the committee has gone one way and not this symmetrical way that you're talking about. Why? What is it about people like
Yeah, I mean, it's a continuing challenge for me to explain my own reasoning, let alone trying to explain the reasoning of others. So.
I know that certain things you can't share with us, but what is the response from your colleagues when you raise it? What are their arguments? When you have these discussions?
Yeah, I mean, I think that you can certainly ask them for their opinions on these things.
Maybe one last question about, we keep hearing more and more now from Fed officials that monetary policy is not a panacea, and that fiscal authorities need to step up a bit. Do you think that there seems to be like a growing recognition inside the central bank that there are going to be limits to any type of future monetary policy actions that the Fed's going to take?
So I want to be clear. I said monetary policy is not a panacea. I didn't say the second part of what you said. Okay. I just want to be clear. I certainly didn't say that either.
I didn't mean to
You said that. I think that for myself, I've never thought monetary policy was a panacea. I mean, I think it's. I remember being asked about this last year at the end of 2010. I think fiscal policy, the ability to move taxes, to change the path of future spending, these are big decisions that have big consequences for our economy, and fiscal policy is always sort of the big player in the room, and monetary policy is about, as our models often say, it's about filling in the gaps.
I did have just one last question about the idea of contingency planning. If you dial back and we're in 2007 before all the crises started hitting, people kept saying today, even at the conference, we never expected this kind of an effect. We were planning for it. How off in a completely different direction and would force you to take actions that, I mean, in other words, is it really going to be all that useful given the potential for Europe that, as we see?
I think that it's certainly a very good question. I think that, but I will say that in terms of the making of monetary policy, while it is a fair statement to say that in spring of 2007, the contingencies that the Fed ended up facing at the end of 2008 probably would not have been foreseen by most forecasters and most members of the committee. And so I think that does pose a challenge. I think, though, that there's a certain argument by continuity, to use too technical language, that if you start to plan for a range of possible outcomes and you end up with a more extreme outcome than you expected, there's a sense in which you can extend what you were doing in the most extreme outcome you imagined and take it further. I think the real surprises I think making a monetary policy, and I don't want to underestimate how unusual the circumstances are, but the making a monetary policy is somewhat consistent, is not that unconventional in a lot of ways. As I was indicating my answer to Steve, it's about telling people what we're going to be doing down the road, offering guidance about what's going to be happening in the future. The large-scale asset purchases, this is an idea that's been around for the past decade, essentially. So I don't think that on the monetary policy side, I don't think that what we're doing now would have been so unforeseen. I think what ended up being had to be done on the fly and was very, very, very challenging was in terms of liquidity interventions, and that is really a whole other story that fortunately is not really in my I don't have to make decisions about.
Thank you.
Okay, we have to wrap it.
Yeah, thanks.
Thank you, sir.
Thank you.